Hello everybody, welcome. My name is Raquel Betancourt. I am the Vice President of Marketing as well as Communications. We are CalcuTech. We are Team 4 and we hold 4th place on our industry. Our marketing strategy as far as the price goes for year 5 was exact, except for quarter 2 where we accidentally input 80 rather than 75. For year 6, we have different prices because we estimated a new product to come out sooner than it actually happened. So therefore, all the quarters we have lower prices than we had projected. Advertising strategy, we decided to take 6% of our quarterly sales and use that as our advertising expense. Yet nice stock on quarter 3 we had the most difference with 67,470 dinars. We expected lower sales, yet we had higher in year 5 quarter 3. Okay, well for advertising for year 6 it was the opposite. We expected to have higher sales in nice stocks, so our advertising was a lot higher than it actually was on quarter 4. For our sales compensations and commissions, each year 5 and year 6 were exact. We didn't have any changes and there was no need to change our strategy. We changed our commissions every other quarter to make sure our sales force was happy and content. Salary as well, we stick to the plan for year 5 as well as year 6. We had pretty good results with our team working for us, and that is it for marketing.
Hi, I'm Ashley Eberhard. I'm CEO of CalcuTech, and I'm going to be talking about our financial decisions today. So first, for talking about bank loans, for our 2-year plan, we didn't predict that we would take any bank loans, and we didn't. We also didn't need any emergency bank loans or anything like that. For our bond issue, for our 2-year plan, we didn't think that we would take out any more bonds, and we didn't. But we did decide in year 6, quarter 2, to buy back $500,000 worth in bonds, and we did this because we had a lot of extra cash on hand, and also to lower our interest expense so that our income statement would look better. Next, stock issue. So we had a 2-pronged strategy for our stocks to increase our stock price, and one of the ways was to buy back stock that we had issued out earlier. Year 5, quarter 3, we had 7,500,000 outstanding stock. So we started buying back in year 5, quarter 4. We bought back 500,000 stock each quarter until year 6, quarter 3. And then we didn't buy back any more stocks year 6, quarter 4. So we ended with 5,500,000 shares of stock outstanding. Next was our dividends. So we wanted to pay out dividends to increase our stock price and to increase our stock price. So we began paying dividends in year 6, quarter 1. First we paid $500,000, which came out to be about 7 to 8 cents per share. Year 6, quarter 2, we paid out $800,000, which was 13 cents per share. Year 6, quarter 3, we paid out $1 million, which was 18 cents per share. And year 6, quarter 4, we paid out $1.3 million, which was about 24 cents per share. Next slide. And then last for our finance section was time CDs. So in our 2-year plan, we didn't predict that we would buy any time CDs. But again, since we had all that extra cash on hand, we thought, why not invest it, get some money back so that we can pay out more dividends. And so that's what we did. So starting year 5, quarter 3, we took out $1 million time CD. Again in year 5, quarter 4, and again in year 6, quarter 2. And we used the interest that we earned on those to pay out more dividends.
I'm Armando Ruiz. I am the Senior Vice President of Operations and Development, and I'm going to discuss research and development first. As you can see, we have our projected R&D costs and our actual R&D costs. We did not deviate from the strategy, and we went exactly as planned, doing a 5% increase every quarter. So we went 126 and all the way down to 177. As planned, we had consistency with research and development. We were among the first 3 teams to have the newer models quicker, and so we were able to distribute them and sell them faster. However, as in industry, we were not able to produce more than 1 model per year. And then, okay, next we're going to talk about training. Training, we were pretty consistent with the plan. but because of underproduction in our plants and we wanted to lower UPC costs, in year 6, quarters 3 and 4, we did a 3% bump. Instead of 94, we went to 97,000, and we increased from 96,000 to 103,000 to boost production. Go to the next slide. You can see right here, we were staying with the plan, and then instead of staying with it, we kind of did a pretty big jump right here, right at the end, and it did help since we were getting much more sales orders towards the end of year 6. Next, we're going to talk about product quality, and up here we have market share. And so for our 2-year plan, we had planned to do quality level 2 and features level 2, and just as a strategy to kind of differentiate our product from the market. And at first, we did see a lot of success raising in years 5, quarter 2, and then having a big jump in year 5, quarter 3, all the way until year 6, quarter 3. However, we did stock out in all of our sales offices, and so our market share did fall in year 6, quarter 4. But the strategy did work. As long as we kept product levels, inventory high, we were selling a lot and keeping our market share strong. Next, we're going to talk about our production plan. Here's our forecasted production plan and sales office orders for years 5, quarter 1, all the way to year 6, quarter 4. We didn't predict any production for NiStock as the company didn't plan to liquidate. But as we did liquidate, if we go to the next slide, you can see is we did have to make some NiStock orders. But we everything was fairly close. We were only like a couple of numbers off when we had to do orders. And you can get a better picture of that on the next. Okay, and for the last slide for production plan, we're talking about total office sales. The red bars right here are actual orders, and the blue bar is going to be our forecasted orders. As you can see, we were fairly close every year. As sales went up, we did have to order much more in certain years, but the strategy was good.
Hello, my name is Sandra Bañuelos. I am the Chief Accounting Officer here at CalcuTech. Today I will be talking about our weighting factors, our estimated and our actual, and also about our industry position. For ROA, our actual were higher than our estimate. This was primarily due to miscalculations. Within the industry, we came in at 4th place, right up here. And for ROE, our actual were also higher from our estimate. This was also due to a miscalculation. We had a good percentage within the industry. We were actually 1% away from Team 3 and Team 6. Okay, for market share, it was not as high as we expected. This was actually due to our out of stock that occurred at the end of year 6. And within the industry, there was a slight but a significant increase. For stock price, our strategy fell a little short than what we had actually predicted. But overall, there was an increase in the stock price. This was primarily due to the companies paying out dividends at the start of year 4 and 5. For our UPC, it actually exceeded our expectations. There was a downward overall UPC trend across the industry due to the closing of the plant in America 1. Our team was amongst the lowest UPC in the industry. Net income, our actual was higher than our estimate. Within the industry, there was a consistent upward trend. However, we were amongst the lowest, but that was not one of our priorities.
My name is George Blasco, and I am the CFO of CalcuTech, and I'll be going over the financials today. I'm focusing on the income statement in regards to the projected and the actuals. I didn't put in the whole income statement because I believe that we should highlight the largest differences in our income statement. Obviously, the largest differences are storage expense and CD interest. The reason storage expense is so high in our actual is because we projected that our regression would have a lot of inventory, and in actuality we had stockouts, and that lowered our inventory at the end of the quarters. Also, for the CD interest, we didn't imagine that we're actually going to invest in CD, but because of excess cash flow, we decided to invest to offset our bond interest. For cost of goods sold, we want to take a conservative approach. We didn't expect a difference so large of 40%, but we didn't want to say that we had a low cost of goods sold and find out that our cash was going to be higher than it should be, and invest in things that we in the end did not invest in. For the net profit before tax, you can see the large difference because of the fact that we overestimated our cost of goods sold, and also because of storage expense. All these differences ended up having a large effect on less net income tax and the net profit after tax. They follow one another. For the balance sheet, once again, I'm not showing the actual balance sheet. I'm just going to show where the largest differences are and explain them. For the cash balances, we didn't expect to have such a large cash balance, but we projected it because we thought that we weren't going to be making investments in bonds or buying back stock prices at such a high cost. For the inventory, once again, our regression showed that we're going to have a high inventory, but we ended up having a low one. So for the net manufacturing equipment, why we experienced such a low projected amount was because it's possible that we over depreciated on our assets. Also, our foreign exchange rate may have been too high, so it underestimated it. For the accumulated earnings, in regards to that, we just miscalculated that completely. And because we miscalculated our accumulated earnings, it affected our total liability and equity. Accumulated foreign current adjustment, it was the same thing. We just overpredicted our foreign exchange rate, which affected us in the long run. And our projected and actual ended up being completely different when it came down to the total liabilities and equity.
Okay, so now that we've looked at how we did these last 4 years, we're pretty proud of where we're standing right now. Yes, we aren't the top competitor in our field, but we think that we're in a very solid place moving into the future, and we believe that CalcuTech has a great future ahead of the company. So looking ahead, we plan to continue to expand the Nystock plant. We have room to add 2 additional lines to that plant, as well as space is already available to build 1 more line. So we're going to start manufacturing that line the first quarter of year 7, and then we're going to build on the other 2 additions at the end of year 7. And we think this will help with our, since we were producing more than we could, or we weren't producing enough to handle our sales orders, we think that expanding will help that. We're also going to increase our training in the plant to again keep up with the sales orders. We're planning on buying back bonds to lower our interest expense further, especially since we predict that we're still going to have a lot of cash on hand moving into year 7. We're also going to continue our strategy for model quality and features and keep our models at quality 2 and feature level 2, because we think that that strategy was working for us to give us that consistent growth that we want to have. So we think that we're going to continue to be that just kind of mid-quality leader in our industry. And we think that that's going to help us to continue to grow in sales and market share looking to the future. And I would like to thank my fellow executives of CalcuTech for giving a fine presentation. Have a good spring break.